It's no coincidence that questions of sovereignty have risen to the top of the agenda at a time of economic anxiety. Politics is famously the distribution of scarce resources, but as political uncertainty and even scandal rages throughout the Eurozone, it raises a question as to just where the power should lie between central banks and their government. Joining me down the line to discuss is economist Alan McQuaid from Merrion Capital Group in Ireland. Alan, the banking scandal in Italy and Spain seems to be yet another blow for the Eurozone, as confidence in the 17-nation bloc is hit once again. Economist Kit Duke summed up his feelings by saying that eyes are on the political scandal in Spain, but also towards bond auction and Mario Draghi's press conference. So there's obviously a lot for investors to take in. But how heavy would you say these problems, if you will, are weighing on market sentiment at present, and how would you see them playing out?
Well, I think it's clear from not just events in Europe in the past month, but also in the US, that it'll be political events more so than economic data that will drive market sentiment in the short term at least. I think coming into the ECB meeting, I think a lot of people were saying that the main focus would be on the strength of the euro and how that was affecting sort of export performance among certain member states. But I think that has now shifted because of the controversies in both Italy and Spain. And I think Draghi is certainly going to face a lot of questions about his own role in the Monte Paschi bank scandal in Italy. I think also the issue of Mariano Rajoy's position in Spain will be brought up in terms of, will he be forced out of office? And if he had a situation there where he was removed from office, clearly then the question would be, would a new Prime Minister stick with the austerity? There's also the issue, of course, of Italy, and even if Silvio Berlusconi doesn't get back into power, he still has the chance, of doing some damage in terms of limiting the power of a new government. So those issues are clearly going to weigh on the markets in the next few weeks.
If we look at the UK, in response to the economy flatlining, the Treasury has suggested amending inflation target, but this is at odds with the Bank of England's goal to provide price stability, therefore prompting King's warning that the government messes with his mandate at their peril. How important is it to strike this balance just right, and is it possible?
It's quite interesting. Clearly, we have the Bank of England are going to be announcing their latest monetary policy decision, but I mean, at the same time, the new incoming governor, Mark Carney from the Bank of Canada, is going to be appearing before the Treasury Select Committee, so giving evidence. So I think he's going to face a lot of questions about how he sees the bank's role from here on in. Clearly, Carney has suggested that maybe a nominal GDP target might work better than inflation. But look at the UK. I mean, the UK has probably had a higher inflation rate than most of the European countries over the last year or so, but it's still maintained a very, very easy monetary policy. So I think a lot of focus will be on, will Carney change things? At the moment, I think he'll keep his cards close to his chest. But I think there are some merits, definitely in terms of maybe looking outside inflation and at GDP, or indeed looking at maybe financial assets, what house prices do, etc., to determine monetary policy. But it's a sticky one. Clearly, I think the UK, is struggling, and despite all the monetary stimulus we've seen from the Bank of England, it doesn't seem to be making much headway. So the question does arise: should a new Bank of England governor adopt a completely different strategy to tackle economic growth going forward?
The concern is also evident in Japan, where the independence of the BOJ is brought into question once again. The Bank of Japan governor yesterday announced he will step down early as a result of government pressure, thus handing Prime Minister Shinzo Abe the task of finding a new team which will inevitably be more like-minded to his ideas. Does this raise a question in your mind for the future integrity of Japan's central bank and indeed their economy?
Yeah, I think it does. I mean, ideally, you want to have independence and no interference from the political establishment. Can central bankers really be politically independent? I mean, the idea that the banks can stand above the political fray looks, or is questionable, to say the least, especially after the last 5 years of making decisions that most people would see as being political. But from Abe's point of view, I think he needs to stick to fiscal policy and getting the Japan's debt problems back in shape and trying to boost the economy that way. I think getting involved with central bank governor and telling him what to do, well, it might reap some short-term gains for Abbey and for the economy. I think longer run it's going to do more damage than good.
The euro does seem to have been running the gauntlet of late. Some analysts have stated they are turning more neutral in the euro dollar, believing that now is a good time to take profits on their euro dollar longs. But Alan, what is your outlook for the euro moving forwards?
Well, that's an interesting question. I think one of the issues that is obviously concerning for the eurozone as a whole is the strength of the euro. It seems to me that policymakers are oblivious to the damage it could do to the bloc as a whole. I mean, we've seen recent research from Morgan Stanley suggesting that fair value for the euro-dollar rate is about 133, which is not far off where it is now. But interestingly, for each country within the eurozone has different fair value levels. And, Morgan Stanley sees 153 as fair value for Germany, and therefore it's no great surprise that Germany is coming out today saying there's no problem with the euro. Ireland, for instance, was 141, so Ireland's not too bad either. But when you look at countries like Italy, 119, Greece 107, Spain 126, Portugal 124. If you take that research at face value, then the value of the euro now is going to do serious damage to those countries and their exports, and put the eurozone as a whole at risk and threaten another sort of blow up in bond yields down the road. I think ideally, given the fact that other countries are going into a sort of a currency war and letting their currencies weaken, it makes sense, in my view, to have euro do the same. Everybody can't have a weak currency, but if US and UK are freely printing money and the Swiss authorities have intervened to put a cap on the franc, I mean, I think Europe just can't sit idly by and let their own currency just appreciate without looking at the consequences on the road. So I think they will come to their senses, in the sense that I think they realise that for the eurozone economy to grow, the euro is going to have to weaken. So my gut feeling is that in the short term, the risks are that the euro may strengthen further on a maybe 1 to 3 month view. But in the second half of the year, I think the euro will weaken against both the dollar and the pound, and I'd see the euro trading below 130 to the dollar in the second half of the year and come year end.
Alan, thank you very much for your perspective today. Well, that's all from me at the moment, but tune back in tomorrow when I'll be bringing you the latest edition of our Commodities Corner programme. But thank you for watching just now, and goodbye.